Lecture 8, product costing. So what we're doing with product costing, and there's lots of things where I've been coming across stuff in the other things that I do in my life in recent times, and I'm going to share some of them with you as we go through this, because I'm pretty sure that many of you will either have dealt with this, are dealing with these sort of things, or will deal with this stuff in the future. So on some level, the ideas are not fairly basic, but it can look really simple, but can provide you some really powerful insights into what you do with your business. So in terms of where we're going to firstly describe the nature and behavior of fixed and variable costs. So the first two parts of today are really getting to grips with the cost structure of businesses. And this is important because unless we can really tease out and separate fixed and variable costs, we're going to make bad calls when it comes to pricing decisions, when it comes to whether or not we should do certain things, whether we should embark on certain marketing campaigns, or various other things around whatever it is that you do with your business. The second bit of that, this is where I gave you that information, the inputs for the spreadsheet, because we're actually going to go through a number of different ways to tease out when you've got a mixed cost situation and actually go, this is a variable component, this is a fixed component. There will be a few things for you guys to do in that. A little bit about tax. And then this last bit is talking about variable costing and absorption costing. Now, the reason we talk about these things is variable costing is really the way we want you to think about things. This is in terms of internal decision making, in terms of making calls on what to do, how much to sell things for, how much to sell, lots of internal decisions. Variable costing is a much better way to do it. Absorption costing isn't just put up there as a straw man. Absorption costing is put up there because this is how inventory and product costing ends up getting put through into the external financial reports. So when you see cost of goods sold in the external financial statements, it's based on absorption costing techniques. Now I'm going to share with you a couple of things I've been involved in, but it's certainly one where people, and obviously I'm not going to name names, but people I was involved with at the time, we were trying to make, I suppose, business decisions. I mean, it was for a fundraising event, but decisions around it where they were using certain techniques to think about it, and frankly, it was wrong, and it would have led us to make some poor choices. So just even some really basic understanding of the difference between variable and absorption costing can help you in a great deal. Which kind of brings down to the last point. So the behavior of fixed and variable costs. What this is talking about is the difference, how a cost moves when activity changes. We could be talking about a physical product. We could be talking about a service product. We could be talking about an event. We could be talking about festivals. We could be talking about a whole range of things. So think about what is something which will move as activity changes and something which won't. So if you're setting up an event, and we'll use events as a little bit at this point in time because I'm involved in setting up some events at this point. If you have an event, you need a venue. You need somewhere to hold the event. Now, generally speaking, the venue hire costs are going to be fixed. Say you find a venue and it fits 1,000 people. It's still going to cost you the same amount as if 1,000 people turn up. The venue hire. There will be other things which are involved, but the venue hire cost itself will not move. So you can already start to see that is that, if you have a fixed cost like that, you want more people turning up because it's going to defray the cost in a better way. Some costs will change proportionately. So as you do more things, the cost of whatever it is goes up. So imagine that you have to pay, and again, this is from experience, at least one I'm dealing with at the moment, where you have to pay, if you're going to be licensed, have a licensed venue, you've got to maybe pay a license fee or a liquor license based on a per head basis. So for each additional person, you have to pay a little bit more. If no one turns up, you don't pay anything. If 100 people turn up, you pay 100 times whatever that cost is. If 1,000 people turn up, you pay 1,000 times whatever that cost is. So these are important to pick out, as we'll see, pick out what these are, identify them, figure out the cost structure. If you remember back, you may remember back, you may try to put this out of your mind, but the function for a straight line is y equals a plus b times x. So that's for a straight line with an intercept. So this, the a, that's the intercept, and b is the slope coefficient. So that tells you where the slope starts. That tells you how slopey the slope is. It's probably not the technical term for it, but you get my drift. So if you've got a fixed cost, y is the dollars on the vertical axis. Activity is just a number of units or the number of people turning up, whatever you want units to be, is on the horizontal axis, the x-axis. If you've got a fixed cost, like the venue hire, there is no slope to it. It is a flat line. Well, they're all going to be flat lines. It's a flat line, but it's got a zero slope to it. So it's y equals a plus 0 times x, so it's just y equals a. So a is the intercept, a is the fixed cost. So that is your fixed. Actually, I'll just say that's your total fixed cost. That's what your a is. It doesn't matter if nobody turns up or 1,000 people turn up, that's going to be the same amount. Quick question, did any of you guys, when she was in town, did any of you guys go to see Madonna?
No, but she was so late in Brisbane.
I heard she was very late. The fact that no one saw her is probably also indicative of the fact that no one actually really did go out to see her. I think there were photos from the Brisbane show once. Was it Brisbane or Melbourne? I think it was Brisbane, she turned up late. And the crowd, like there's literally, whatever the entertainment centre is up there, it was an indoor one, it was like half the seats were empty. And the thing is, so that's a big, the cost of production, if the seats, one person turns up, half the people turn up, everyone turns up, that cost of production is going to be the same regardless. So you want more people turning up because the cost of production will then get spread across more and more people as that happens. So no changes, production volume increases or decreases. So the left is the first line. The right, if you've done some calculus, would be the differential. So as you go, the change in cost over the change in units. So we're picking up, this is a downward curve. This is economies of scale in play. You have one person turn up, fixed cost of 10 grand. That's going to cost them that's 10 grand if only one person turns up. You do it 5,000 people, that's $2 a person. That 10,000 is being spread across. You have 10,000 people turn up, it's $1. The more units you push out, or the more people turn up, the cheaper it is. That fixed cost gets spread out across more people. You want more people turning up. Variable costs, if it's a purely variable cost, there is a zero cost when there's 0 units, so it starts at the origin. This is your variable cost per unit. That's the B there. So if this is, the intercept is 0, so it starts at the origin, it would be y equals 0 plus b to the x, which would simplify down to just y equals b to the x, y equals b, not b to the x, sorry, that's wrong. Y equals a plus b times x, it would just be y equals b times x. Number of units, cost per unit. The higher that is, the steeper the slope, the quicker costs go up. Variable costs vary in direct proportion to changes in volume. So the more you make, the more it costs, or the more you sell, or the more people turn up, whatever it is. The variable cost per unit when it's expressed as the change, sort of the change in rate, it doesn't change. That change in rate is fixed at $20 per unit. We can get mixed cost situations where we have an intercept and we have a slope. So we have some sort of fixed component to it and we have a mixed and a variable component to it. Water bills are a good example of that. Utilities bill, electricity bills. So water bills, even if you go away for 6 months and you don't use any water at all at home, you will pay a fixed infrastructure cost charge on your water bill, and then you will pay a usage on the megalitres that you use over the top. Now, that generally, the fixed infrastructure cost charge, at least in the ones that I've seen, generally dwarfs the amount of usage that you have. So water per litre is quite cheap. At least it is if you get it out of the tap. If you buy it in a bottle, it can be insanely expensive. Why is this all important? Because to understand how to make money or decisions, or the impact of decisions on your ability to make money, we need to know our cost equation. And our cost equation is, as we've got up here, y equals a plus bx. But before we move on to the next bit, I want to tag this into why this becomes important for next week and then a few weeks after that. Profit we had for the first half of the course was revenues minus expenses. I'm just going to change that a little bit just to keep the terminology right for what we're doing with this type of accounting. Revenue minus costs, or revenue minus total costs. Now we've just broken down total costs into the variable components and the fixed components. So what we have is, to get profit equals revenue minus total fixed costs minus total variable costs. So everyone's happy. We haven't done anything really fancy there. It's just gone from profit is revenue minus costs down to profit is revenue minus fixed costs, total fixed costs minus total variable costs. We can this is at its minimum. This we can change again. Revenue equals total fixed costs minus variable cost per unit times the number of units that you sell. So revenue minus, not an equals. Revenue minus total fixed cost minus variable cost per unit. This is just that. This bit here is your A. So if we included this as a separate thing, this would be A plus B times X. If I am selling one type of thing, whether it be one type of pen, one type of ticket to a show at the same price, whatever it happens to be, how do I figure out my total revenue? What are the two things I need to work out what my revenue is? So say I'm selling this pen, or like lots of them. I need the quantity of the pens that I sell, and I need and the price. So I need price per unit times, so that's so now what we have is we have price per unit times quantity minus total fixed costs minus variable cost per unit times quantity. That one. So if I'm ignoring tax at this point, if I want to know what my profit is, I need to know, one, what price I sell this thing for. I need to know how many I sell. That's the same one over there. I need to know what my total fixed costs are going to be, or estimate them anyway. And I need to know what my variable costs are going to be. If I have those four inputs, I know how much profit and again, this is all estimated, this is all sort of planning for the future, but I've got those 4 inputs, price, variable cost, total fixed cost, and number of units. I can work out profit. The same if you want to change something else. So if you think about this is a 5th input, pretty much for next week and then in 2 weeks' time, you're going to get 5 inputs, or the ability to make one of those 5 inputs, and you'll have to get 4 of them. And there'll be one which is clear, and that's the one you have to solve for. So we could say, given we want a profit of $100,000, and this price, this units with this fixed cost, how many do we need to sell? And it's just rearranging things, putting stuff in, bang, you figure out quantity. Or it could be, given the amount we're selling for this and this, what price should we pitch it at? You can start to work that stuff out. That's where we're going with this. But inherent underneath all of that is we need to understand what our fixed costs are, and we need to understand our variable cost per unit. Quantity is going to be, generally speaking, driven partially by price and just by the economics of the market that you're dealing with. Price is going to be driven by what decision you want to make it at and then the economics of what you think you're going to get away with. So you control this to the extent that if I want to sell this pen for $1,000, I could do that and no one's going to buy it. I get to set that. The market gets to say whether that's a good decision or not. So this is set by us, this is quantity, but to work out what effect that has on profit, we need to figure out these things. That's what we're doing today. We're figuring out the total fixed cost, the variable cost per unit, and we're working out when we've got a mixed cost, how to separate those mixed costs out into a variable component and a mixed variable component and a fixed component. But before we get to that point, there's one thing we do need to talk about, which is the relevant range. I want to hold an event. I hire a venue. It costs me $10,000. So that would be my $10,000. That would be the A in that function. Thing is though, that's fine. I can use that $10,000 as part of my cost function, but the venue only holds 1,000 people. So I can't say, well, we could have up to 5,000 people and my fixed cost would be 10,000, because that's not right. I would need a bigger venue, which would cost me more money to do that. So the relevant range is the range in which that linear function holds. So that 10,000 holds over the range of 0 to 1,000 people, or 0 to 1,000 units. If we wanted to have a bigger venue to hold 1,000 to 5,000, that may cost us $25,000. And that would be the relevant range for that level of production. So you need to be careful that what your cost function is works for the amount of production that you want to have. I couldn't use $10,000 as an input if I want to have something with 10,000 people. It wouldn't work. I'd need to upscale to a bigger venue. That'd cost more. We need to think about that. So that's what relevant range is. Happens too with variable costs. Variable costs can go like that. They can actually, over various relevant ranges, they'll stay linear, but they'll actually change over that period. And to give you an example of one, you may well have used something like this. Officeworks, want to go get some printing done? Most of us, certainly when I've gone there, I haven't needed any more than 500 copies. I might need like 1 or 2 copies. If I wanted color, which is why I'd go there because I don't need black and white printing, it's 88 cents for an A4 page if I want to get a couple done. But if I want to get 1,000 done, it's going to cost me 43 cents per A4 page. The variable cost per unit changes. Quantity discounts. So that's the relevant range. It is important. Keep an eye out for it because the example we're about to do actually has a really good indicator of it. Okay, So the next question I've got, or the first, well, not next question, a question I have for you guys, and this is an honest question. I'm not going to get anyone haul them up and say, can you show the class how to do regression analysis? I just want to get a level of where people are at and just how to pitch this. How many of you guys have either done or know about regression analysis? Damien, Ina? Okay, so either everyone else doesn't, or you're just too tired to put your hand up to say that we do. So I'm going to go, I'm going to get a sense that, there is some level of we haven't covered this before. I'm not going to go through it in a huge amount of detail, like the background behind it, but I will go through some. So for those that know what it's about, bear with me. We're not going to get you to do regression analysis in this subject, but it is useful to know, and I'm going to show you a really quick way that Excel can set it up for you. And it's not using any formal sort of analysis pack or the data packs or the kind of tools that they have there. So what we have here is dollars on the Y, units on the X. And what we have is a set of data points. Now this could be, let's say it's for the same company over a period of time, whatever this cost is, as units go up, we can see there is a general trend. As the number of units increase, the cost goes up. What regression analysis is trying to do is just to find a line which best fits all of those points. So you could see if we drew a line like down here, that would be ridiculous. That doesn't make sense at all. Drawing a line this way wouldn't make sense at all. You can see just eyeballing it, that's a straight line, or as best as I can do. That's a straight line. It's going through those data points. And without getting into the sort of maths of how they do it, roughly speaking, what happens is the system will take each of these points, and I'm going to do it for a few of them, and it computes the distance data point to the line which it is set up. So it creates all of these distances, and then they take the square distances up, they square that distance. They take all the distances of all the points, they sum them all together, and what they're looking for is the line which minimizes that distance, that total distance. So this looks pretty good. It sort of averages out quite nicely. This one down here would have huge errors, and so that wouldn't work. And that's just what regression does. Now there are ways to do this by hand, and extremely painful ways to do it, and we're not going to get you to do that. What I'm going to show you is a very quick way to do it on Excel without having to have any sort of special software in it. I mean, certainly if you've got special stats packages, you can do this stuff and it's really easy, works really well. But I'm going to show you a hack way to get around it. So this is the data that we have. We've got a pizza store with overhead costs for the last 12 months, number of pizzas, and you can see just by looking at that it seems to be some sort of positive effect there. But you can also kind of tell that it's not purely variable, because if we take one at random, say month 8 with month 4, month 8 had a $6,700 cost for 1,200 units. Roughly double that, that should be about 13,000, and it's only about 9. So it's not purely variable what's going on here. There's a fixed bit and there's a variable bit which is happening. So what we're going to do is we're going to tease that out. Now that's the output if you used some fancy stuff in Excel. Most of this for our purposes isn't all that useful. What we're going to do is a different way. This is the same data I've put in. So if you've had the chance to put this in already, play along. All we do is we select the data and we insert. It might be in different places if you're using a Mac or a PC, or even the version of version of whatever Microsoft package you've got. And in and insert a scatter graph. I am going to minimize this a bit. All right. So we've inserted a scatter graph, and you can see there is some sort of linear relationship going on there. That's pretty self-evident just by looking at what we've got. So the only thing I've done at this point is insert a scatter plot of that information. Now, to find out the regression information, and which is the coefficient that we need, I will simply go down to one of the data points. You'll see some information pop up. If you're using a Mac, you might have to two-finger click. If you're using PC, just right-click. Add a trend line. We want to keep it as a linear trend line. Now that's mostly where if you're not worried about the equation, that's where most of us would leave it, and you can see there's a line running through it. But what we want is to actually find out the equation behind it. And I'm going to display the equation, and I also want to display the r squared, because I just want to make mention of that. And that's it. That's got what we need. And if you've got the slides in front of you, you can see the arrows point to a pretty similar set of numbers. Now they've got this around. This is the A, the 3998.3, the 2.0919. That's the B. So they've got them the equation around the different way. But I will kind of clean this up a bit. What we have is y equals 209. Oh, hang on, I'm doing it. Y equals 3998. I'm just going to round off, plus 2.09x. So the fixed cost is nearly $4,000. So that's the fixed bit. If we didn't sell any pizzas, we're spending $4,000. And each additional pizza, in terms of the overhead cost, is $2.09. That's why we've done this, so we can unpack that. Now, why is that important? Let's imagine that $2, that cost function, that is the cost function for the pizza. That's it. That's all there is. What is a minimum price that we could sell pizzas for so that we're not losing money? I'm not worried about quantity at this point. That could go. But what do we, at the very minimum, what do we have to sell pizzas for? No, that's a fixed cost. Each individual pizza. If you're selling a $4,000 pizza, mate, it must be pretty good. $4? No, looking at this cost curve, which is what we just made out. If this is the full cost curve, this is not just the overheads. If this is everything. What's that? It's not 10. What's that? 210. Yep, 210. At 209, say this is exactly 209. At 209, if we sold the pizza for 209 and the variable cost of 209, we're not making any money. We're not going to go off to pay this off. So we sell a pizza for $2.10. We're going to have to sell a huge amount of pizza each month because we make 1 cent in profit per pizza, and we have $4,000 to pay off each month. So we'd have to sell 400,000 pizzas a month to make that worthwhile. Now, to me, I don't know, that seems like a lot. So if you had that at, say you were selling a pizza for $4.09, you're making $2 a pizza on your variable costs, which means you've got to sell about 2,000 pizzas a month to at least cover your costs. That makes sense. Does that make sense to everyone, what we've just done? That's pretty much all we're going to do. That's the idea behind the next 2 weeks, is just identifying what your variable, what your fixed are, separating it out, and then knowing what to do with it. And inherently, you guys know what to do with it. So a lot of what I'm going to say isn't going to be new. It's just going to be a slightly different way of talking about it. So we've done this with regression analysis. Now, just a comment, or a couple of comments. One, the R squared. For those that are statistically minded, the R squared tells you how well the line fits the data points. An R squared of 1 means it fits perfectly. Every data point is on the line. An R squared of 0.89 is pretty damn good. Like, I'd be really happy with that. We're pretty comfortable with that. Another comment, and this is just more, well, actually 2 more comments. One, relevant range. We can see the relevant range we can talk about here. Maybe you could extend down lower, but realistically, you're talking between a range of about 1,000 and about 3,000. We couldn't be talking about this as a cost function for 10,000 units. It'd probably be something different. You need a bigger pizza oven. You need another pizza oven. So this cost function wouldn't necessarily work outside of the range that we're looking at. Chris, you look like you wanted to say something. No. Okay. The other thing that I would do, and this is just personal preference around showing graphs, this, as it's set up as a graph, forgetting about, making it nice and pretty colors and whatnot, if you want to do that, as a setup within the graph, it's set up badly. All of this space over here is empty. All of this space down here is empty. It's all squished up into the top right. I would change that so that we even it up down the bottom, and we even it up. So now down here isn't the origin. It's 1,000 units and 6,000. But it looks a lot neater. You look at it and go, okay, that makes a lot more sense. So that is regression analysis. Again, think about why we're doing this. Why we do it is to get that cost function. Fixed component, variable component. That's what we want out of this. The high-low method. This one, I will explain it, then there's an opportunity for you guys to do it. We don't expect you to be able to do what we've just done in an exam. The high-low method is something that you could be able to, it's a really easy way to do it, and it could be something to be done. What we are looking at with the high-low method is high activity. Now, an important talking point with this. We're looking for high-low activity, not high-low dollars. So we just cast your eye down, and we know that that's going to be the highest because the arrow tells us that it is. But even if we didn't, you can see that's the highest. We come down here, that's the lowest, that's the lowest. Now, what we don't do is then you don't independently find the highest and lowest numbers here and use them. What you do is you find the highest and lowest numbers here, find that one, and then go across. So this one is 10,100. This is the lowest, it's 6,750. It may well work out that that's the case anyway, but you're always going down the activity and then across, down the activity then across, not down the activity and then down the dollars. What we're trying to pick up with the high-low is the marginal unit. We take the highest, we take the lowest. We can see the difference between the number of pizzas is 1,400 pizzas. The difference in the amount, 3,000 something. And what we're doing is allocating the difference in the cost over the difference in the volume. So the 3,350, so that 10,100 minus 6,750 is 3,350. 3,350 is the marginal cost for producing those extra 1,400 units. But we want to find out what the marginal cost of producing one unit is. So divide it through, and we get $2.39. If you've done this on your calculators, you'll probably see it's $2.39 and something. If you want to round it down to 39, that's fine. So we end up with $2.39. So this is a different cost. It's trying to get the same cost function doing a different way. It is different, but it's using a different method to do it. To get the variable cost, to get the fixed cost, you can do it for both the high and low, or you could just do one. because it's going to work out the same or very, very close if there's rounding. And we can do this because your total cost equals your total fixed cost plus your total variable cost. If we pick the high method, we have total cost of 10,100 equals total fixed cost, that's what we're trying to find, plus 239 times 2,600. We know that has to be the case. Like, that is just the formula for it. Total cost separates out into fixed and variable. We know total cost. We can work out total variable cost. Total fixed cost is the thing which we're trying to solve for, and we just add it all up, times it through, do what we need to do, and we end up with total fixed cost is 3,886. Look, if you sort of squint at it, they look the same. It's not perfect, obviously, but they're pretty similar. And I'll show you why. So the equation is different from the regression because the regression fits the best line. The high-low just picks it between 2 points. And we can actually see this.
Question.
Yes.
Is there why would you pick to find the total fixed cost? Do you always pick the high data point, or do you do the low point? Which one do you do, or how do I know which one to do?
How do you know which one to do?
I use the high-low method.
If you use the high-low method, you always use activity.
Yes.
And you just pick the biggest number, and you pick the smallest number.
Yeah.
And then you just go to the number sitting next to it.
Yeah. But to find out the last slide that you had, to find out the total fixed cost, how
Yep.
do I know which of these to use? Or is it
Oh, okay, yeah. So the question, So the question is about, do you use the 3,886 or the 3,882? Either. Like, if it's getting down to that sort of, it will not be material in what we're doing. So yeah, either, because that's been driven by the fact it's not actually $2.39, it's $2.39 something, 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 something. Either. But you can see why it's different. Have a look at the data points here. What this is the regression line, the line of best fit, and it's fitting right through it. This is the low point, low activity. This is high activity. This point is above the line. This point is above the line. If you actually were to match through them, you can kind of see it. This has a steeper slope. If you do look at it, it has a steeper slope, which makes sense because you can see it's 239 versus 209. It is a steeper slope. And it's got a lower intercept. So if you were to keep that slope going, it's actually going to cut underneath it down to the bottom. But it's pretty similar. So given we've just done that, now it's your turn. The reason businesses are in business is because they want to make money. But the thing is, the money that we make, if it's a for-profit organisation, if it's for a company which does pay tax, not a not-for-profit or charity or something like that, if you're potentially a tax-paying organisation, the money that you get after you make your sales, after you make your profit, has to then have tax taken out of it. That is, I suppose, unless you're Apple and can shift everything offshore somehow and just not pay any tax at all. But assuming that you do have to pay tax, and most businesses do, we need to take into account that tax is impacting on this. This is going to be a brief introduction to it. We'll talk more about taxes next week as we get into CVP analysis. The after-tax cost is found by adjusting the pre-tax amount by 1 minus the tax rate. So the corporate tax rate at this point in time for some companies in Australia is 30%. And up until the budget last year, it was 30% for all companies. Last budget, they changed it for some small companies, we're at 28.5%. They've changed it again this year so that some small companies are down to 27.5%. And then everyone else starts to move down Smaller, slightly bigger companies each time move down to 27.5, and then everyone will move down to 25. So, which is going to make it annoying for us because we like to use this just 30%. It was easy, and now it's going to be dependent on the company size you're dealing with. But if you've got a company, and if they spend $20,000 on something, and we're not dealing with capital gains, we're not dealing with any sort of accelerated depreciation issues, we're just dealing with a bog standard income tax deduction. That $20,000 with a 30% tax rate means, yes, you're going to pay $20,000 for something now, but you will get a tax deduction, and that will lead to you paying $6,000 less tax. So the net effect of that cost is only $14,000. Now, there's going to be a timing difference because you'll pay for it now, and it may take a little bit of time before you get the saving, but the net effect is going to be $14,000. Next week, we will start to build in what, if we want to make a certain profit, if we want to make a certain after-tax profit, how do we start to do these things? So we'll see some of this play out in more detail next week. Which brings us to absorption costing and variable costing. The key in all of this is in the name. Now, why do we talk about this? Variable costing is based on what we've just done here. And for internal decision-making purposes, this is what we want to use. Works way better. We'll see how that plays out, but it works way better. Absorption costing is not just in there as a straw man. We do need to use it, and we use it for external reporting purposes. We use it in financial statements. When we think about cost of goods sold, when we think about inventory valuation, the cost of inventory, if you're making inventory, if you're not just buying it in, if you're making it, it's all the various parts, it's labor. If you're having to get stuff shipped in, you're paying for the shipping. If there's levies or taxes on things, if there's factory rent as an overhead, if that's being built in, electricity, all this stuff. Because remember, inventory, like any other property, any other asset, the cost of inventory is the cost of everything included to get that asset in the state and where you need to use it. So all of these things get put in, even though, say, parts are variable, labor is variable, but electricity for the factory is going to be across everything. Factory rent is going to be a fairly fixed cost. So we're actually allocating some of these costs in. That's what absorption costing is. Product costs attached to the product. So all the product costs go in, including these sort of things. They're getting absorbed into the units that we produce, and then they go out as we sell them. With variable costing, only the variable things attached to the units. The fixed costs are separate from that. So we would be including these sort of things, potentially shipping, depending on how it works, levies. But things like electricity and factory rent or overheads, those get treated differently. And we'll see why that is in a moment. So absorption costing, actually the difference between the two is very much around, and I will stress this down, we'll stress it all the way through, is the fixed overhead. The fixed overhead is the big difference between these two. We already talked about variable costing for internal, absorption costing for external. So if we think about manufacturing costs, even though we talk about we're moving into a knowledge economy service, service sector, all the rest of it, we still need stuff. A lot of stuff still gets manufactured. Phones, laptops, tables, building parts, whatever. The material, this is a 5. It's a little bit out of date now, and the way it's acting up, I probably need to get a new one. I've had it for a fair bit longer than the 2-year contractual period. Direct materials, I went Googling yesterday. I don't want to know what you've just been watching. The direct materials for an iPhone 6, just did some Googling the other day, about $210 for the componentry for an iPhone 6. Now, iPhone 6 doesn't retail for $200. iPhone 6, if you're playing it outright, is about $1,000, depending on the exact model, but you're talking about $1,000 there or thereabouts. So why do they sell it for more than $200? Well, partly because they can, but it's what the market can bear. Why do people spend, what was it, Ed Hardy clothes? I remember, this is about 10 years ago, I remember a mate of mine was like, look at this shirt, it cost me $90. And I was like, what are you talking about? That's ridiculous. Like, why are you spending that much on...
Or the lady who was called $150,000 handbag.
Yes. Oh. Like, at some point, didn't she just go, hang on, I'm going to have to pay this back?
Yeah, and am I not drawing attention to my...
Anyway, that's a different... So if you didn't see, it was a girl who got an unlimited overdraft and spent $3.5 million, lots of it on handbags. Anyway. It's not free money, people. Direct material, so about $200. Direct labor, that is the direct labor in terms of on the factory line actually building this stuff. That is done on a unit, worked out on a unit basis. You don't need any production, you don't need to pay the laborers anything. Now, you could argue that
Does logistics come into that?
logistics probably wouldn't be part of that. There'd probably be an overhead, without knowing exactly what the logistics you're talking about, but say there's probably be more overhead related. But depends. Depends on if you're not producing anything, would you have zero cost for it? If it's that, then direct labor, but direct labor is actually people making this stuff. You could argue that the way things you hear about Apple and the production plants, that maybe the labor costs aren't that high, maybe unethically so, but that's a story for a different day. Manufacturing overhead, depreciation, rent, manager's salary, possibly some logistical costs. Some of it's going to be fixed, some of it's going to be variable, just like what we were talking about with electricity and water earlier on. Those direct materials, so DM, DL, overhead, those are the three components which go into inventory. Now, for absorption costing, if you've got a physical copy of this, I would draw a line down the middle. I would then highlight the fixed overhead, because again, this is where the story is being played out. The variable costs, direct materials, direct labor, overhead, direct materials, direct labor, overhead, regardless of the method, they go against the unit. So the stuff which goes into an iPhone, the labor on the iPhone, and any variable overhead cost in relation to the production of the iPhone get attached to the phone. All the selling, general admin, all that stuff goes period cost. So this is about the product. This isn't about selling and admin. What is different though is the overhead. Even though the overhead does relate to the product, if it is fixed, we include it for absorption costing in the product costs, but for the variable costing, we're only keeping variable costs in here. So because it's not a variable cost, we push it over and just look at it from a period point of view. This story is very much about the fixed overheads. So for most of the rest of this, we're going to use this as an example. So we've got Lulu's pockets, and they produce 100,000 units each year. That's important. We have 30 cents of direct material, 35 cents of direct labor. Both of those are variable. We have 10 cents of variable overhead. As the name suggests, it's variable. We have 5 cents of variable selling and admin. It is variable, but it's not a product cost. So it is variable. It will change as you sell different amounts, but it is not related to the product. So if you might have your sales staff that they will get 5 cents for every unit that they sell. So it's not actually making the product, but it is a variable cost in that way. They sell nothing, they get nothing at all. Fixed manufacturing overhead costs are 30 and fixed selling and admin costs are 10. So the product costs, and again, we're just looking at direct materials, labour and overheads. We're not worried about the selling costs at this point. For absorption costing, we include direct material, we include direct labour, we include variable overhead, and we include fixed overhead. For the variable costing, we just include the costs related to product, which are variable. So direct material, direct labour, variable overhead. Comes out $1.05 and 75 cents. So the question then is, how did we come up with the 30 cents for fixed overhead? And I'm pretty sure you're about 2 steps ahead of me there. But in case you're not, we had a fixed overhead of 30,000. And we had 100,000 units of production. We're allocating that into each of those. Equals 30 cents. That's why it's absorption costing. That's what's happening. The units that you have produced are absorbing that fixed overhead. You're taking it and you're spreading it out across what you've done. And you end up with 30 cents. So here, we need to take a little bit of time stepping through what's happened. And look, and this is going to be one of those topics where you do need to, we've had a lighter week last week. We've had, it's a bit of a quieter time. I told you we were going to start ramping things back up. This is that process. On the left-hand side, that setup looks really similar to what we've done previously. Sales, less cost of goods sold, gives you gross profit. Less selling and admin and costs gives you net income. That, just like what we've seen before. But that's because that's what it is. It's an external reporting. So I'll just walk through how we got those numbers. So sales, 200,000 is, even though we should have explicitly said somewhere, we're assuming a sales price of $2. Sales price of $2 times 100,000 units sold. So we produced and sold 100,000 units. What's the next bit? Less cost of goods sold, 105. That's the $1.05 from the previous slide times 100,000 units. That gives you 95,000. Less S&A. That almost sounds somewhat inappropriate. $15,000. This is a $10,000 fixed sales and admin plus the 5 cents variable times 100,000 units. So that's where the $15,000 comes from. All right. So that's how we get 80,000. We worked out the product cost previously of $1.05. The sales price is given. Sales less cost of goods sold. Then we've got your sales and admin. We just look at what they are and we push it through. That gives you $80,000. Look, and I mean, that report does tell us something, but for internal purposes, it's not anywhere near as handy as the next one. Once we go through it, we will see why. Sales, so this is a variable costing. Sales of 200,000, which is the same, $2 times 100,000. So that's the same, it has to be. Less variable costs. So this one, we separated out between inventory and selling and admin. That's basically what's happened. These are sort of inventory related costs, these are selling and admin costs. We're just doing a separation differently here. We're separating it out on variable or fixed. But it's the same idea of going from sales to income. Variable costs, 80,000. Now note here, and then there's a note on the slide, it's not just the variable product cost. The variable product cost was 75 cents, but there's also a variable selling cost. So this is the 0.30 plus the 0.35, so direct materials, direct labour, plus the 10 cents in variable overhead, plus the 5 cents in variable selling and admin times 100,000. So that all becomes 80 cents. That gives you $120,000, and that's your contribution margin. I'll talk more about that, why it's called the contribution margin, in a sec. You take away your fixed costs, which are 40,000, and your fixed costs are the 30 fixed overhead plus 10,000 fixed selling and admin. 120 minus 40 gives you 80. There's an important reason we do this. And I mean, some of these points are dotted through the slides, especially later on. One of the big benefits for doing it this way is because by disaggregating your fixed and variable, you can hone in on the stuff which is really relevant here and now. Because remember, your fixed costs don't change. So in a sense, these are irrelevant. I mean, they're not. I mean, we're obviously paying them. But if we're looking to sort of how things move around, this isn't going to change in the short term. Obviously, in the longer term, you can adjust your fixed costs and you can get more equipment, or you could get bigger capacity or smaller capacity. But in short term, that doesn't really move too much. But as you change quantities, this will really affect up here. Whereas if you look in the top one, sales and admin is mixed, fixed and variable. Cost of goods sold is actually kind of got a mix of fixed and variable because there's your variable fixed overhead has been allocated into it. It sort of muddles things up a bit. Your variable cost keeps it much cleaner in terms of a setup. So my question to you is this. Sales less variable cost gives us our contribution margin. It is so called because this shows you how much your sales net contribute to paying off your fixed costs. That's what it's doing. I have this pen. The cost of making this pen, all the variable costs in relation to making and selling this pen is 80 cents. I sell it for $2. How much profit, forgetting about the fixed costs for the moment, how much profit do I make on each additional pen sale? Yeah, I make $1.20 each time I sell a pen. My fixed costs are $40,000. My contribution less my fixed costs gives you my net income. My question to you, how many pens do I need to sell to break even? And when I say break even, in case anyone's not come across it, break even is a net income of 0. Break even is the point when I'm not losing money. This is selling 100,000 pens and I'm making 80 grand. I want to know how many of these I need to sell to not lose money. All right, does anyone have a number for this? How much do I need to break even? I know a few people have got it. 33. There's actually a really pedantic point with this. 33,333. Does that sound about right? Yeah, 33.333 repeater. Does that sound about right? Okay, it is, but it isn't. First question. Can I sell you a third of a pen? So it can't be repeated. It has to be a full number. So then the question is it 33,333? It may seem like this is where rounding actually, this is about the 1 point when you're calculating break evens, which we'll do in more detail next week. So admittedly, this is the first time, and I'm not saying you're wrong, I'm just, because we haven't done this before. 33,333, we actually have 33,334. We will always, even if it's 0.1, we will always round up. And the reason we round up is the break-even point is the point where you're not losing money. 33,333 is just under. You sell that many, if you actually work it through, you will lose a tiny bit. So you need to take it up. Anyway, small issue. But the way we got it, yeah, you're right. You're making $1.20 per pen. 40,000 over $1.20 gives you 3,334 pens. So that's important. At a minimum, if we're going to make any money, we need to sell at least 33,000 pens. Then you need to look at, well, at that price point, is the market going to bear that? Is the market big enough? Do we think we can make that sort of sales level? You can start to sort of interrogate that a little bit more. This is why this method is so good for this stuff, because you can separate out these costs really easily. Now, to give you an idea, I'm actually in the process. We had to sign off on something yesterday about it. For just, it's a small thing, it's a community thing, but we've got a fundraising event coming up. Our cost structure, there was some toing and froing around this. For this event, our fixed cost, $6,000. So this is actually a real life thing that's happening. Fixed cost, $6,000. Variable cost per unit, 19. So the things that get added in doesn't really matter at this point what they are. The variable cost for each individual person, no one turns up, we don't have to pay $19 of anything. One person turns up, it's $19, 100 people turn up, it's $1,900 and so on. If we have a ticket price, and if we ignore sales over the bar and any other sort of money that comes in, if we're just looking at this is the only revenue stream is the ticket sales, if we have a ticket price of $20, how much do we make per ticket? It's not a trick question. We make $1 per ticket. So $1 per ticket, contribution margin per unit, $1 per ticket. How many tickets do we need to sell to break even? 6,000 tickets. So ticket price of that, we need 6,000 tickets. Now, that's a problem. One, it's a community thing. We're not going to get 6,000 anyway. Two, the capacity of the venue is only 300. So, I mean, and that's the thing. You look at that and go, restaurants have a certain number of sittings, certain number of people they can fit in the place. If they work out that on their cost structure of their food and whatever it is, that they would need 500 people to come in a night and they could only literally fit 100, they're never going to make money. So you do need to be aware of this. And I think I sent you guys an article last week with how the cost structure of a restaurant works. You know, this stuff's important. Ticket price of $29, $10 a person, that's 600. That's still problematic. 49 gives you $30 a head in terms of contribution margin. That gets you down to 200 people, well within capacity. There's always a question of, like, from a market point of view, will the market bear that ticket price and will we get 200 in sales? But at least from a capacity point of view, that's okay. We could have a ticket price of 1,019. We'd only need 6 people to show up to break even, and I can tell you now, we wouldn't get 6 people to show up for this at that ticket price. So that's then getting into the market point of view. But this is where this stuff helps you quite a lot, because you can work this out quite quickly and easily, and you can have sensitivities on running different numbers and different scenarios. You can start to play around with the cost structure to see what happens, and it's quick to do. Then it's really up to you to think, well, you know, can we get at 49, can we get 200 sales? Maybe you can, maybe you can't. But then that's a question around, you know, the marketing and how you do those sort of things. So that's one of the reasons why the variable costing setup is such a useful one, because it lets you see, no one turns up, we're $6,000 out of pocket. So we need to be making money over the variable cost to pay this off. That's why it's called the contribution margin. We've actually now just done a fair bit of what next week is about, which is good. We go into a lot more detail and some sort of nooks and crannies about this, but that's effectively what next week is. Cost, volume, profit. We're looking at the cost of the things, we're looking at the volume that we have, we're looking at the profit that we want to make. This next bit, we have been through a lot today. I am going to talk you through year 2. But the thing I really want you to just remember, if you sort of, as we're going through this, eyes glaze over, or, you know, it's getting late and you're hungry, remember this. This whole story about why this is different. The differences turn up because what you produce and what you sell are different numbers. Now the whole reason these things end up becoming different is because of how fixed overheads get treated. They get treated in a particular way here, they get treated in a different way over here. That causes the difference. This is completely a story about the fixed overheads. So if you're kind of trying to look back over this, whether it be between now and next week, whether it be just before the final exam, I'm hoping it's going to be earlier rather than later, but everyone gets to make their choices about how they prepare for these things. It is a story about the fixed overhead. And I don't know where my pen has gone. Thank you. Right, so what I'm going to do is break down, I'm going to do first the absorption costing side of things and unpack where the numbers have come from. I'm not going to do sales, it is purely about cost of goods sold and selling and admin, and then it's purely about the variable costs and the fixed costs. I'm not going to do the rest of them. So if we look at costs, can you see? So we look at cost of goods sold. So this is for this number up here, the 84,000. The cost of goods sold, how this is created for this side is 105 times 80,000. That's how we came up with that number. But to really see why the differences come in, I'm actually going to have to break this apart a bit. So that 105 is the direct material times 80,000 plus direct labor times 80,000 plus variable overhead times 80,000 plus the allocated fixed overhead times 80,000. So this 30, 35, 30, 10 and 30 gives you $1.05. The sale and admin costs are 10,000 plus 5 cents times 80,000. That's where those numbers came from. That's where the 84,000 came from. That is where the 14,000 came from. I've just unpacked them. It's calculated the same way as what we did the previous year, just using 80,000 instead of 100,000. That's all. If we now do the variable costs on the variable side, we have variable direct materials, 30 cents at 80,000, plus direct labor, 35 cents at 80,000, plus variable overhead, 10 cents at, it's a bit repetitive, but we'll get there, 10 cents at 80,000, plus variable selling and admin, 5 cents at 80,000, and that's it. That's your variable costs. I need to make this a bit smaller. Then we have our fixed costs, and this is 10,000 sell and admin plus fixed overhead of 30,000. That's how we got the 40,000. So at that point, everyone should be on the same page. We've done the same thing that we did previously, just using 80,000, not 100,000. No difference. Why I set this all out like this is I want to compare those two sets of numbers to see what has caused the difference. Because it was the same previously, and in this year it's not. So variable, 30 cents and 80,000. This is your direct materials. Direct materials, 30, 80, 30, 80. That's the same. 35, 80 for direct labor, 35 cents at 80, direct labor. That's the same. Variable overhead, 10 by 80. That's your variable overhead. Your variable overhead. 10 by 80. Variable sales and admin, 5 cents at 80, 5 cents at 80. Variable S&A. This is your variable S&A. 10,000, your fixed S&A. All the same, all the same. The difference is caused by the fixed overhead and the way it's treated. In the variable method, the whole fixed overhead goes in. 30,000, it's fixed, it's 30,000. Doesn't matter if you produce 0 units, doesn't matter if you produce a billion units. Yep. Yep.
And then on the next one down, you've got 80,000 by 5 cents.
Yep.
So how is that the same?
They're not the same.
All right.
Yeah, no, they're not. They're not meant to be. No, but this relates to that. So sale and admin, yeah, they go into different places. So that's what I'm saying. Like, I'm laying it all out so you can see where things go differently. But there is a difference. And that difference is caused because you've got 30,000, the full 30,000 fixed goes into the fixed bit for the variable costing method. But for the absorption costing method, what we first do to get this 30 cents, that 30 cents is actually 30,000. That number is that number. We allocate it across the units that we produce, which is the 100,000 units, to get you the 30 cents. We then multiply that by the 80,000 units that we sell. So the difference is not that the 30,000 is different. The $30,000 is there. But in here, it is absorbed into each unit made. And because not every unit gets sold, you're only allocating out 80% of that cost. So what you'll end up with is actually a cost of $24,000. Even though the fixed cost was 30, you are only sending out 24,000 of it. And that, if you think about it just for a second, remember inventory, all the costs go into inventory. What we don't sell ends up in ending inventory. That would be part of the $6,000 which hasn't gone out would be part of the ending inventory, which is still on your books. This is going to be one of those things, I can sense it. This is my 4th class this week. This, and having done this stuff myself, this is going to be one of those things where you do need to sit down and spend some time with. It is one of those things. But sitting behind that this is purely a story about how the fixed overhead is allocated. So if you need to write down in big letters somewhere, this is a fixed overhead story, you at least know where the issue is and you can come back to it and be like, okay, it's something to do with this and how it's allocated. That's where it comes out. And the same will hold true for the next year, except for year 3, it's the same process, except instead of $80,000, 80,000 units, you just change that to 120,000 units. These all match up. The only thing which is different, it'd be 30 cents times 120, which gives you 36,000, which is actually more. Which is why you see the profit here less than over here, which is why you see the profit greater here than over here. Trust me, you're just going to have to, it's one of those things. You're going to have to just spend some time looking over it.
So the label on that is VSA as well, top yellow highlight.
And so say that again.
The label is VSA, variable selling.
Yeah, so I just said, variable selling and admin, fixed selling and admin. Now, over time, as long as you ultimately end up selling everything that you produce, it all matches up over the longer term. There's going to be some discrepancies in the shorter term. Now, one of the things I want to talk about from this is the variable method. As we've just discussed when we worked out the break-even point, it allows you to make decisions a lot better. It also can allow for better decision-making generally, because there are things you shouldn't include, there are things that you should and think about. So potentially about unethical practices, but also about making decisions right. Now we have time, and this is another one of those things where, just to put it, rather than just talk about, it's not made up companies, but rather than talk about in the abstract, I'm actually going to give you a real scenario that I was part of a couple of years ago. It was around another fundraising event, and I'll just give you the background behind it, and then I want to see what you guys say. So to give you some background, it was a fundraising event. It actually turned out to be quite a big one. It was held down in Darling Harbour. I think the actual venue now doesn't exist anymore. But we were looking at close to 1,000 people to turn up. Like it was reasonably big. Let's just assume, because I can't remember the actual numbers involved again. Total fixed cost. Total fixed cost is $27,000. So venue hire, whatever other things we had to do. Total fixed cost is 27 grand. Our variable cost per unit was 90. We had a ticket selling price. We were selling tables for $1,500 or seats for $150. So sales price of $150, variable cost per unit of 90, and we sort of estimated at minimum we wanted about 900 people in. We were trying to fill it. We did have a little bit more capacity.
It wasn't an election time, was it?
No, it wasn't an election time one. So the fixed cost per unit was, what's that? I think it was about 30. All right. So with 900 people, which is what we're sort of getting to, we had an estimated price of about $120 a ticket, including all costs, the fixed costs and the variable cost. We were selling them generally to the market for $150, but we were a couple of days out, and we wanted to try to bump up the capacity to get to capacity, get above 900, get to close to 1,000, which was capacity in the room. And people were coming to us saying, well, look, we don't really want to do the 150, that's a bit much for us, but we want to turn up, we want to help out, so we're willing to pay something, but not 150. So my question to you guys is this. Put yourselves in our shoes. That's our cost structure. That was what our original selling price was. The only thing we want to make sure, we're willing to drop the price to these people. We're willing to go lower. We don't want to lose money on the ticket sale. So we at least want to cover costs on the ticket sale. They may pay other stuff once they're there, but we want to cover costs on that sale. Forgetting about any other sort of things that you need to consider, what is the minimum, take 30 seconds, a minute to think about this, what is the minimum price we could offer to these guys that would allow us to cover the costs at that point? So we don't want to lose money on that point on the ticket sales. What is the minimum? So take 30 seconds a minute. What is the minimum we could go down to? We might not have gone down at that point, but what is the minimum we could offer them as a price point? And this was a legitimate thing. I remember when it was happening. I remember what went on about it, but take a moment. All right, so what do you reckon? What do you think the minimum we could have charged these extra people for? $30. No, we're going to be losing money if we charge them $30. Extra people over the 900. 120. No. No. It's the 90. Because think about it. The fixed cost is the fixed cost is the fixed cost. Even if it wasn't quite over 900. Doesn't matter if even 900 people showed up. Even that $30 is an absorption standard. We want 900 people. Some people went, and this is the problem with this, because I remember when it happens, going, no, you don't do it like that. That 27 grand was going to be spent anyway. That happened. So for the additional person, it wasn't like there was some new fixed cost that was going to be part of it. It wasn't like that there was another $30 for the fixed cost. The fixed cost had happened. So as long as we charged them the variable cost for the ticket, so the meal package, the drinks package, as long as that was being covered, that extra 90, we charged them 91, we'd make $1 on that ticket. The 27 had already been dealt with. We couldn't change that. So what we're then starting to get as relevant costs. Bless you. We'll talk about that in 3 weeks' time. So this is getting at some issues which we haven't necessarily talked about, but we still do have some of these ideas where we can see we've got the cost structure. We know what the fixed costs are. We know what a variable cost per unit. The variable cost per unit, that's the relevant thing. So we could have charged them 90, well, 91, we could have charged them 95. I can't remember what we ended up doing because there's other considerations. What happens if people you sold tickets to for 150 start to find out that they're not going to be happy with that? Oh, I thought, yeah, well, either way. They're not going to be happy with it, absolutely. But you see differential pricing in a whole bunch of things.
What did you do?
We did knock down the price. I don't think we went down to 90, but we went down about 120 or so because it was treading that line between, well, we want more people in because it'll add to the occasion, but then there was only one off. Yeah, but you don't want to piss people off who paid the full price. So there was that tension in there of where do you go with it? But think about airlines. Airlines differentially price tickets all the time. The person that you're sitting next to, there's no way they paid exactly the same price that you have, but the difference is you will never know how much they paid. They're getting the same thing as you, but you don't know what they paid. And there's a whole bunch of different metrics that they use. They're even talking about knowing the postcode of where you're coming from, and they're looking at doing stuff like analysing the postcode you're coming from and saying, well, are people more willing to pay or able to pay, and they'll charge them more based on that. Do they seem to be taking the same trip annually? Are they going to certain, do their family in certain places? They know that starts to happen, so they'll be like, your price, your elasticity of demand for you individually is different to somebody else, so they may start to ratchet up the price on that. That's where the metrics and the frequent flyer things. There's been talk about that, yeah.
Yeah, because they're the only ones mainly that always take postcodes.
Well, no, I've seen stuff in the papers that they're talking about really ratchet.
That just made a point. They're running if you went.
Yeah. The other is actually on the variable cost per unit, speaking about planes. Think about frequent flyer seats. Sometimes it can be pretty hard to get on them. If they've got high capacity planes in terms of not high capacity, planes at capacity, they'll rarely allow frequent flyers on there in terms of having a seat. Because think about so open question to you guys, if a plane has capacity, so there is a spare seat or a couple of spare seats, what is the variable cost for you to fly? Say we're flying from here to LA. What's the variable cost of them providing that service to you? Not in the dollars. I don't know necessarily what the dollars are, but what are the variable things that they need to pay for over and above that one extra person?
The taxes and the fuel, airport taxes.
Yeah, so some of the airport taxes, they might be done on a per. Is that done? I don't know if they're done.
Do that, and I used to work in the.
Okay, so we know someone who knows what they're talking about. So some of the taxes are fuel, but the fuel load for an extra 100 kilos, 120 kilos, person and baggage, as compared to the size of a plane, it will be something, but it probably won't be that great. What else? Meals. How much do you reckon the meals? Yeah, the marginal person. So how much do you reckon the meals would probably be worth? Yeah, they wouldn't be worth much. Look, some of the planes are getting better, but the meals aren't exactly going to break the bank with them. But there's not a hell of a lot else. So as long as they pay for a little bit of fuel, a little bit on the tax, a little bit on the meals, that's their cost covered, because a lot of the costs are going to happen anyway. That plane, assuming that plane is flying from Sydney to LA, the crew's going to be, like, unless you bump it up into that one extra person means they need to carry one extra crew member, the crew's going to be a fixed cost, the pilot's a fixed cost, the plane costs a fixed cost, the majority of the fuel is a fixed cost. The ticketing and all that is generally a fixed cost. All that stuff is generally pretty fixed. So the marginal person is so cheap to run on a plane, which is why frequent flyers to them doesn't, the cost of providing a seat, if there's capacity, isn't much. If there's not capacity, that's different. Then you're kicking off someone who's paid for a seat, and they don't want to do that because they're losing money in that case. So knowledge of a plane's fixed cost, you can see why that works out that way. But yeah, I wouldn't say the plane meals necessarily cost a lot of money. Been on enough of them. Yeah, so we talked about this. It is performance measurement and just working out what you need to do. Variable cost, fixed cost. By separating those out, it allows you to make these decisions way quicker, and they make the decisions better. Variable costing focuses attention on relevant product costs. Variable cost. The fixed stuff's not relevant on a short-term basis. It's not relevant for what we're doing. We get to see the actual behavior of what happens. You can start to run sensitivities really easily and see where break-even points are and what sort of the things you need to do. Much more easily than under the other method. And it picks up a cash flow movement a lot more. So variable costing, the fixed cost, you'll see the full 30,000 go through, for example. On the absorption costing, it depends on how much you sell. If you don't sell it all, then you don't see all the fixed costs go through. If you sell more than the fixed costs that you've incurred this year. So it matches up in that way a bit better. And that's it.